Well, is diversifying your 401k with bonds and stocks, is it the way to go? Always the way to go. Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, I've got a place for you to go get that question answered. Go to prudentmoney.com and send a question in, and I will get that taken care of for you. I do answer all the questions myself, and I know they don't go into a little dark hole where nobody ever gets their answer. If in the past, if you've ever sent a question in and did not get an answer, please give our office a call or call the station and leave your number, and we'll make sure that we get you taken care of. We take it very seriously and want to be there for you as your trusted resource. That's all at prudentmoney.com. It's a couple of big weeks for the markets as we finally get our sights in on interest rates and whether they're going to go. Well, they're not going to go up. Probably not. Less than 1% chance that's going to happen. Can't imagine it going up. But they more than likely will go down. The question is just how much will they go down? So what the Federal Reserve Board looks at are two different metrics. They look at how many jobs have been created, what's the job market look like, because one of their mandates is to make sure that the job environment stays healthy. And then the second is, are prices stable? So last Friday, we got the latest jobs report, and the report said that there was 142,000 jobs created. Now, that's not too terribly bad. I don't think it's enough to even warrant the fears of inflation. Typically what you see is you start to see the jobs report show that there's a reduction in jobs in a pretty strong trend over 2 or 3 months. We're just not seeing that, at least with the government numbers they're letting us see. Now, they did announce about 3 or 4 weeks ago that, well, let me back up and say this. The Department of Labor goes back and revises, if it's needed, revises the employment numbers that are given out each month. And they put the revision as the correct and accurate one. And they found, when they went back over the last 12 months, no big surprise here, but they found a deficit of 881,000 jobs. That's a pretty big number. Spread out over a year, and the numbers we're talking about, it's not that terribly bad. But they pointed to the birth-death ratio as being one of the problems. And we've been talking, if you've been listening to me for years, you know that I talk about this every time, or just about every time, the unemployment numbers come out. The birth-death ratio is separate from the jobs number. The Department of Labor goes out, figures out that X number of jobs were created versus X number of jobs lost. This is the actual number of jobs created. They make a big fanfare about it if it's positive, and it's that number is released on financial media every first Friday of each month at 7:30 Central Standard Time. So we got that number. That number is 142,000. And there's another number that they create and literally create it. It's not something that comes from a formula, a counting of jobs. It is, in fact, I don't know how they run that formula, but the bottom line is they estimate, and you got to love government estimates, they estimate how many jobs the Department of Labor failed to count as jobs and how many jobs were lost that they missed. So to me, it's not a very accurate number because it's government estimates, and I don't trust government estimates because I think they can say whatever story that you want them to say. For this last month, 142,000 jobs were created. Of those, the birth death ratio added 100,000. So if you were looking at it from the standpoint, is this really a good or bad number? If you took away what the birth death ratio put back in, you would have negative 42,000 jobs created. Not lost, excuse me, not created, but lost. So I don't know where that puts us with the decision to how much to cut rates. But here were some of the other reports that came out. It says layoffs soared in August. Now that's not obviously a very good thing, hitting their highest total for the month in 15 years. While year-to-date hiring hit the lowest in the 19 years of a Challenger Gray and Christmas survey, the report showed the biggest growth in planned layoffs came to the technology field, with companies announcing 41,829 cuts, the most in 20 months. Now, that number kind of surprises me, that they would show in the technology field that there was going to be that many jobs lost. You would think in the technology field you wouldn't see that. You might see it someplace else, but you wouldn't see it. Payrolls processing firm ADP reported Wednesday that private companies added just 99,000 workers in August. Now that's a separate, more of a secondary kind of a report, but they're talking with privately held companies, and no government jobs or anything added into that. And they just added 99,000 workers. Well, once again, it's not a negative number, but it is the smallest gain since 2021. So everything is slowly trending in the wrong direction as far as the employment situation, which of course is very closely linked to the recession story. And I remember a couple of years ago, everything looked like that we were going to be heading towards a recession, and all the indicators that are pretty accurate, all proven to be wrong. And will it happen this time? Who knows? But it definitely looks like, it could be the companies are holding back. It's interesting because with confidence, you hear that Wall Street expects a Trump victory, which would put Wall Street at a lot of ease. Kamala Harris, on the other hand, frightens Wall Street in the biggest way, and just some of the things that she's announced lately she wants to do. And can keep in mind something. I'm kind of got off track. I need to get back on what I was talking about. If she releases an economic plan, and there was a big taxation push in this plan, you've got to realize that whether it's all Democrat or whether it's all Republican or whether it's split, these things have to get voted into law. And these politicians, because the types of cuts she's talking about would affect middle class, would affect upper income people, would affect maybe even well, not so much probably lower income workers, but it's going to definitely cause problems and higher taxes for a majority of people who are investing. Now, someone asked me about that the other day, and I said, number one, probably will never happen. Number two, she's pandering to her base, the base that wants to see big liberal tax cuts. I don't personally think she's in it to do that, but she has to say it, and it definitely gets her attention, and that's not going to surprise anybody what she wants to do. However, the chances of it happening, I think they're once again, politicians have the tendency to announce that they're going to do something in order to pander, if you will, to and make happy the part of the Democratic Party that really wants to see that kind of thing. I thought it was just Bernie Sanders who wanted to see those same types of things, and obviously it's more than just that. So there you have it. Now, as I get back on track, the Federal Reserve Board is looking at employment as we discussed, and they're looking at stable prices. That is what we will get this week, leading the up to the interest rate meeting next week, the 17th and the 18th, with a decision on interest rates on the 18th by the Fed. But on Wednesday of this week, the CPI, Consumer Price Index, which tells what inflation's doing, that's going to be announced. And then the second is on the 12th, is the Producer Price Index, and that tells what happens at the company level as far as the wholesale number of making gadgets and widgets and that kind of thing. Are their prices going up to create? So should be an interesting couple of weeks, and of course, then we've got which should be very telling tomorrow for a number of reasons. The debate between Vice President Harris and former President Trump should be a doozy. Does anybody say that anymore? A doozy? Anyway, should be pretty interesting. And and what you're looking for, well, I won't get into all that. Well, maybe we'll talk a little bit about that tomorrow. This is far from a political show or outlet, and I want to keep it that way. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Hey, we're up against a break, so stick around, and I'll be right back. Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Once again, if you've got a question for me, please go to the website at www.prudentmoney.com. Send your question in, and I will get you taken care of. That's all at prudentmoney.com. Last couple of Saturdays, because I typically don't do this, when I'm in the car running errands, and Saturday's a big day for financial advisor radio. And like I said, I generally don't listen to any of it, and I don't listen to really anything that is basically like what I do, to put it that way. But I ended up, because I was on FM, an FM channel, and I ended up hearing a radio show done by financial advisors, and they said something to me that just struck me, and I want to bring this up because once again, it's all about interpreting what advice that you're getting, and how does it relate to your life? Does it make sense? Is it accurate? And there was they have a mailbag type thing where the listeners send in questions, and the question came that there was 80%, that the husband had 80% in stocks, and the 80-20, and the wife was very conservative, very concerned. The husband was not concerned about the market and taking so much risk. So you have one spouse, and you probably could relate to this if you're those of you who are listening, that you may be having these same conversations with your spouse. But there's one spouse, and I see this all the time. One spouse that wants to be aggressive, and I would say if you're in retirement, which they are, I didn't mention that. If you're in retirement, 80% in stocks is pretty aggressive, but more on that to come in a second. So this gentleman comes on the radio, and he starts talking about, well, what they mean by 80-20 is that you have 80% in stocks and 20% in bonds. So if stocks go down, and 20% of the portfolios and bonds will go up, and that will kind of offset those losses a little bit. That's what diversification is. And I took a, I thought to myself that that was interesting, and I hope that I don't do that when I talk about my opinions about things, because once again, as I've always told you, is that anything I talk about, money wise, stock market wise, economy, it's just simply my opinion. I'm not trying to be right, and I don't know if I'm right. This is just what I think, and that's just the way it is. It's as I've always said, there's no absolute truths when it comes to money except one, and that is that there are no absolute truths. There's only opinions. Time is going to tell you what worked, what did not work, and obviously none of us have a crystal ball. But the problem that I had with that is because there's people I'm sure listening to that program, like there are people who listen to this program, that take what is said, and they look at that as advice, which I would strongly, that may be where you want to start, not necessarily as advice, but I would definitely look into anything before you accepting it as a way of doing things. But anyway, he said 80-20, and the 20% always offsets part of the 80%. Well, I wouldn't say always. And I think that I would make the disclaimer is that nothing works, as you and I talk about many times, nothing works 100% of the time. And a couple of years ago, when bonds and stocks are having a problem. Now, granted, if you go back, and I did the research on this this is a long time ago, but there was something like 95, 96% of the scenarios where bonds and stocks went the same direction. So you didn't get the diversification. So this is one of those things, I think I would say it this way, between on say like a 80-20 type setup, diversification where you have the majority towards stock and the majority towards bonds, the majority of the time that diversification helps. But there could be times like just recently where that has not helped and all of your investments have gone down. So you got to realize that I think diversification is the best tool that you've got in a 401k plan since it can't really be managed. That would be my second area of focus, which would be diversification and allocation, how you allocate towards stocks. But if this were my client, I think I would tell them that we got to talk through it and get to a point where we figure out what they value versus how the market works. Because I don't think they care how the market works. I think what they care about is what's important to them and that they are invested accordingly to their values. So you talk about what a stock breakdown of 80 and 20 it really means. And I got to tell you something that, especially lately, that I just don't even think, if you're looking at really offering a strong diversification strategy, you're going to have to go out to at least 60% stocks, 40% bonds to get any hope of getting a real strategy that works or potentially works for you. So anything else doesn't really move the needle. I've always kind of called it diversification because it looks good from our standpoint as advisors. But the 20% in bonds, yeah, it's going to help a little bit. 10%, I don't even see any place for really. But 50 or 60-40 is where you start, and then you go down from there. And once again, if you're using bonds, not just any bond will do. You got to see what bonds are doing, are performing well in that particular environment. So just a clarification for our friends on, we'll just say the other radio station, 80-20, 20% bonds does not always affect positively the 80%. There can affect negatively, so you need to know that. We also talked a little bit about last week, and I wanted to bring this back up, about changes to your credit cards, because this happened in a big way back during the last financial crisis. I think that we're going to see it happen again. And what they're doing is they determine what is the risk profile for credit card holders, and maybe it's they have this amount of the credit limit is in debt, has a credit limit, some debt against the credit. So in other words, everybody who's got $50,000 worth of credit card limit, and they're over $40,000 worth of debt, that's a red flag. I hope that you understood what I meant by that. So there's several criteria that they could say, boy, these particular accounts are high default risk, so we need to keep an eye on. So what they do is they lower credit limits, they increase payments, and they can do all this. And so, but what you don't want them to do is to close your account. They'll let you keep paying on it, but they just won't have any. And they'll do this. They will do this towards a percentage of their clientele. Banks will. A couple of things, 3 things that I think that you could do that will help if you're carrying a lot of debt, that they like to see. They like to see auto pay because they know that money's coming out. You're confident. If you're not confident, you're probably not using auto pay. If you're confident with your monthly payment, you're using auto pay, and they look at that and they use. I'm speculating, okay, but I think I'm right on this. Use that card monthly and pay off the activity monthly. It's good for them to see that you're still using the card. And I'm not saying, please don't add to the debt, but pay off any debt or use that for, say gas for the month, and then you pay off the gas. And then for absolutely never be late with a credit card payment. That could hold very serious consequences in this particular environment. Prior to this environment, it would just mean probably a phone call immediately the day that you were late, and they will dock you $35 or $45 for being late. This time they may shut some things down on you, and you certainly don't want to do that. And I know that there's a lot of people who are depending upon credit cards as an additional emergency account. And it's just the way things are today with everything. The whole idea is to get back and get credit healthy again, and do the best that you can and be the best steward that you can of what God's given you. Hey, this is Bob Brooks. If you got a question for me, please go to the website at www.prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.